Basically, it's the first revision of the standard since it was first issued back in 2009. And leading up to this point where we are now with the issuance of the standard, the ISB went through an extensive consultation process, gathering information from users of the standard to try and understand what could be changed in the standard to make it more user-friendly, to make it more effective. And ultimately, what we now have culminated in several changes to the 2009 version of the standard. So if you have a look at what the slide that you've got in front of you now, that sort of talks to some of the changes that have been made to the standard. So basically, it's a list of all the areas in IFRS for SMEs where there have been changes, where changes have been made. So you'll find that as we go along, a lot of the changes will be around clarification of what was meant in the original standard. There's some areas where they've gone and they've completely rewritten the standard altogether. For instance, when you have a look at income taxes, there's been a complete rewrite of the income tax section of the standard. If you have a look at things like property, plant and equipment, they brought in additional optionality which we didn't have previously. And in some areas, they've taken on some of the changes that have been made to full IFRS, and they've brought it into IFRS for SMEs, but it's not in every single area, as you will see. The next slide that I'm going to show you now basically talks to the areas where there will not be any changes. Well, certainly the changes that we're seeing in full IFRS will not filter through to IFRS for SMEs. The new financial instrument standard in IFRS 9, for instance, that will not impact IFRS for SMEs. Neither will IFRS 15, the new revenue standard. Leases, the ISB is currently in the process of working on a new leases standard at the moment. And again, this will not necessarily result in a change to what we have in IFRS for SMEs. We might find that in the next version of the SME standard, maybe they might take a few of the principles that they established in the new leases standard, but for this version of the standard that we're currently dealing with, there certainly will be no changes there. Now, to begin with, I want to take us back to where we've been with the SME standard and the definition of what an SME is and who can apply the standard, the IFRS for SMEs standard. Now, the definition is pretty straightforward, and none of this has changed. An SME is an organization which does not have any public accountability. Now, an organization is deemed to have public accountability only if it meets two criteria, and it must meet both. It must meet one of the two criteria. It either must have publicly traded equity or debt instruments, or it must hold assets in a fiduciary capacity for a broad group of outsiders as one of its primary businesses. Now, the first one is pretty straightforward. If you're a listed company, you're listed on a stock exchange, well, then chances are you've got publicly traded equity instruments, so therefore you'd not be in a position to apply the standard. The second one has been a bit of a contentious one because when you have a look at some banks, some credit unions, insurance companies, then not every single one of them holds assets in a fiduciary capacity for a broad group of outsiders as one of its primary businesses. So therefore, this has been the cause of much consternation in the past as to, well, what standard do they apply? Can they apply the SME standard or not? So what the ISB have come back with is, well, we need to apply some sort of judgment here. And they've come back and simply said, look, additional wording to the standard, most, but not all of these types of entities also have public accountability. And they've given us this list of these potential entities that we need to consider. So it'll be a matter of a judgment call when it comes to the application of the standard for these sort of entities. They've also gone further and they've said, when you are an SME and you belong to a group of companies, what does that mean for you specifically? Does that mean that you can not apply the SME standard when you're preparing your consolidated numbers? If other people in your group don't meet the definition of an SME, where exactly does that leave you? And the simple answer that they've come back to is that A group may not apply the IFRS for SME standard if any of the companies in the group do not meet the definition of an SME. So therefore, on a consolidated basis, you then need to go make sure that you prepare financial statements in terms of full IFRS. However, in the preparation of your separate financial statements, there's no problem there at all. Whether your parent company does not meet the definition of an SME, or there's other companies within your group of companies that don't meet the definition of an SME, that's of no consequence. For your separate financial statements, you're at liberty to apply the standard if you meet the definition. Now remember the principle behind the consolidated financial statements. The preparation of consolidated financial statements is that the information must be prepared the information must be prepared on the same basis for all companies within a group. Another principle that we had in the old version of the SME standard was undue cost or effort. Now, undue cost or effort sort of pops up all the way along in the SME standard from time to time. And one of the things that was clarified as part of the Q&As, the questions and answers that were issued back in 2011, and some of them in 2012, was on this application of undue cost or effort and what it actually means. Now, the Q&As that were issued back in 2011 and 2012, unlike the IFRS, they were not compulsory for application. So basically, you had a choice as to whether or not you were going to apply a particular Q&A or not. Now, what's happened with the Q&As here is that some of the Q&As have now been incorporated into the standard, and this is a particular case in point. Now, the undue cost of effort exemption is applied in specific circumstances, and it cannot be applied as a general principle across IFRS for SMEs. Now, we need to be clear on this, because when you do apply undue cost of effort, you need to explain why you've applied the particular principle and where you've applied it. So that will be part of the disclosure requirements in your financial statements. Obviously, the whole determination of when to apply it, that will depend on your specific circumstances as an organization. And it will also depend on management's judgment of the costs that will need to be incurred in order to be able to meet a particular criteria in the standard. And we also need to consider the benefits that will accrue from applying the requirement. Now, when you're looking at the costs that will be incurred, obviously that will be from the perspective of the organization that will incur the cost. When you look at the benefits, that must always be considered from the perspective of the potential users of the financial statements. Now, all of this assessment and the application of judgment, that must always be done at the point at which the financial statements are, or at the point at which the transaction is being recognized initially. At each subsequent reporting date, we must always go back and reassess. Are we now in a position to incur this cost, and will we get the benefit from it, and so forth? Or will the users of the financial statements get the appropriate benefit from it, and therefore, is it warranted? So it can't be a once-off decision that is taken and it's applied on a blanket basis going forward. It must be revisited on a regular basis. Moving on to the preparation of financial statements. I'm going to start off by having a look at the consolidated and separate financial statements, then we'll move on to other aspects of your financial statements under the SME standard. On the consolidation side of things, we did mention earlier on that where you control another organization, you're required to prepare consolidated financial statements, where you take into consideration all subsidiary companies and obviously account for any other investments that you might have within your group of companies. However, there is an exemption that exists, And an entity is exempt from preparing its consolidated financial statements if it meets two criteria. It's a subsidiary of another organization, and that parent company prepares consolidated financial statements either on a full IFRS basis or on an IFRS for SMEs basis. Now, in that scenario, as long as those two criteria are met, no problem, the exemption can be applied. What has now been brought in, which is a little different from where we've been in the past, and there's a little more information that has been given here, is around where subsidiaries are acquired with the intention of disposing of them. Now, if an organization acquires a subsidiary company with the intention of selling it within a 12-month period from the date of acquisition, not from the date of its reporting, from the date of acquisition of that subsidiary company, then it is required to measure that investment in that subsidiary company in the same way that it would measure its financial instruments in terms of Section 11 of the standard. Now, Section 11 of the standard basically says, well, measure your investments either at cost or at fair value. Then it gives us a whole list of things that we are measured at cost and other things that are measured at fair value. Now, in this particular case, because it's an investment in another organization, the presumption is you can determine fair value reliably. If you can't determine fair value reliably, then the undue cost of effort exemption that we spoke about earlier on can be applied. And that will then mean that that investment can be carried at cost. Now, as we know with assets that are held for sale, the sale must occur within a 12-month period. If after 12 months the entity still controls a subsidiary company, it will then be required to go and consolidate this entity because, well, we have not been able to meet the criteria of holding this asset, this investment, for sale with the intention of disposing of it. But that's assuming, again, that we don't have the intention of disposing of it. If we remain committed to disposing of it, and the delay has been caused by something that is completely outside of our control, then no problem. We continue to apply Section 11 accounting. No problem at all with when it comes to that. But again, that judgment must be documented. Whatever judgment is applied that will then lead to a conclusion on this must be documented, and it must be very clear as to why we still control that particular subsidiary company, or why we think that we still meet the criteria that for holding that asset for disposal. Another thing that is also important when it comes to consolidations is just making sure that the information that is presented, that we use in the preparation of our consolidated financial statements, it must be prepared on the same date, unless it is impracticable to do so. So if we have a 31 December year end, for instance, and we happen to have one company that has a 30 September year end, well, that subsidiary company must change its reporting date to be uniform, to be in line with everybody else. So we have coterminous year ends. May not always be possible. The 30 September date might have been dictated by circumstances in the jurisdiction in which that organization exists. Now, in that situation, then we'd need to prepare financial statement information at 31 December for that organization to enable us to have coterminous year ends. Even though that entity, that subsidiary company that we have got an investment in, they might still prepare a set of financial statements at 30 September. Now, where we're dealing with 30 September, 31 December, well, we're within 3 months of the main year end, so that one will not be too much of a problem. But if the date happened to be greater than 3 months, if it was a 31 August year end, for instance, now in that situation, it would be very difficult not to prepare an additional set of financial statements at 31 December and get away with it. So therefore, you need to make sure, to the extent that you can, use the most relevant, the information that is available to you at that point in time, make any adjustments for any significant transactions that may have occurred that need to be borne in mind as part of that, as part of just of updating the results to ensure that we've got all the same dates, the coterminous year ends that we spoke about. When it comes to the preparation of your separate financial statements, the standard does not require a parent entity to present separate financial statements unless, again, local requirements dictate that. So if you do decide that you are going to prepare separate financial statements, as a parent company, you may use the accounting, you may choose which accounting policies you would like to apply on that in the preparation of those financial statements. Previously, IFRS for SMEs said apply fair value or cost methodology in accounting for your investments in the subsidiary companies. What's now happened is that in line with the change that we've had in IAS 27 and full IFRS, the equity method is also permissible in the preparation of your separate financial statements. So that's an additional methodology that is now permissible. So where you've got your investments in associate companies, your investments in joint ventures, the equity accounting method can certainly be applied in the preparation of your separate financial statements. That will basically cover where we're preparing consolidated financial statements and separate financial statements. The next area where there's been some changes is around the accounting for financial instruments. We've had an issue going back into the past as to what would happen where an organization finds that Section 11 and Section 12 of IFRS for SMEs don't give it sufficient guidance on the accounting that should be applied to its financial instruments. Maybe the financial instruments are a lot more complicated than IFRS for SMEs can handle. So in that situation, IFRS for SMEs very categorically permitted that organization could look to IAS 39, apply IAS 39 in accounting for those financial instruments. However, it was also very categoric that the disclosure relating to those financial instruments must not be in terms of IFRS 7 in full IFRS. For the disclosure, presentation and disclosure, we must always come back to IFRS for SMEs. Now, part of the concern that has arisen over the years with all the changes that have happened to IFRS, to full IFRS and IFRS 9 having been issued is, well, what happens when IFRS 9 comes into play and IAS 39 is withdrawn? Does that mean that IFRS for SMEs appliers would have to go and adopt IFRS 9? Well, that's now been clarified in this version of the standard. IFRS 9 comes into effect in 2018. However, if you are applying IAS 39 at the moment, then you're required, based on current requirements, you're required to apply the latest version of IAS 39 that is effective at your reporting date. After IFRS 9 becomes effective, if you continue to elect to apply IAS 39, then you must apply the version of IAS 39 that will be an issue at that point in time. So whatever version of IAS 39 will be in force on 31 December 2017, that will be your accounting option going forward. You won't be given the option to adopt IFRS 9 at all going forward. So effectively, your accounting will be frozen from that point going forwards. So I hope that clarifies what the accounting will be and how the accounting will be applied going forward when it comes to people that have taken the option to apply IAS 39. Now, moving back to the other types of financial instruments that we have, IFRS for SMEs like I said, has got Section 11, which deals with basic financial instruments, and Section 12, which deals with other financial instruments, which is basically the more complicated financial instruments. Now, with your basic financial instruments, you look at your cash, you're looking at debt instruments, you look at loan commitments, preference shares that are non-convertible, those sort of things. Now, the general measurement basis for these sort of financial instruments, these sort of financial assets, is that they're carried at cost, with the exception for preference shares and ordinary shares, which are publicly traded or whose fair value can be measured reliably without undue cost or effort, which are then measured at their fair value. But going back to what I mentioned earlier on, is that where, in clarifying what undue cost or effort means, the ISB have gone and they've said, if you find yourself in a situation where you've tried to determine the value of an asset, but it's going to entail undue cost or effort on your part, then fall back on cost. That would not be a problem at all. And again, this is just more clarity coming in here in terms of what the accounting for such financial instruments should look like. So with your basic financial instruments, initial measurement is always based on the transaction price, and that takes into consideration any transaction costs that you incur. So whether it be stamp duties that you've paid, whether it be brokerage fees, those sort of costs, those will all be capitalized to the cost of the transaction. However, there is an exception, and the exception is where you're dealing with financial instruments, basic financial instruments that are measured at fair value through profit or loss, in that we exclude any transaction costs from those transactions. Again, there's an exception when it comes to the application of how we then determine the carrying value of these assets. If you find yourself in a situation where you've entered into an arrangement that is effectively a financing transaction, then you need to measure your financial instruments based on the present value of the future cash flows, applying a discount based on market for similar debt instruments. So I may need to discount present value the amount back to today's value, taking into consideration that if the market is lending money at 10% and they would lend money on a similar sort of asset at a 10% rate at the moment, but the effective rate of interest that is being charged on this instrument is 0 or a lot lower than that 10%, then I basically need to go and work out what the present value of the cash flows are going to be, and that's the number that I'm going to record on my books as the carrying value of my asset. Obviously, I'll need to go back and revisit that at each reporting date, and then based on that, make any adjustments that are necessary in my financial statements. Where I can't determine fair value without that undue cost or effort that we spoke about, then I can fall back on cost. Now, to clarify what undue cost or effort means, is that the standard clarifies for us that if there's variability in the range of values that are attributable to a particular asset or a liability, and I can't therefore pinpoint where exactly what the number is that relates to my particular asset or liability, then I could argue that there's undue cost or effort in determining what this number is, because now I need to go and spend more money, which may not necessarily be beneficial to the user of the financial statements, and at the same time, I may not be able to afford as the person as the entity that's going to have to incur this cost. Or there's probabilities, there's various probabilities of estimates within that particular range which I can't reasonably assess. So if that is the case, again, even if I go and spend the money, one person that I approach might say to me, the asset has got a value of X. The next person that I approach says that the value of the asset is another number. And these numbers are not in a ballpark that I can sort of say, well, I'll split the difference. Now, in that situation, again, I might argue that there's undue cost to effort involved in obtaining this value in these values. So therefore, I'm simply going to fall back on cost. But again, like we said, is that where you do apply the undue cost to effort exemption, you would need to disclose in your financial statements where you've applied it and why you've applied it. So be prepared to make sure that that disclosure is provided if you are going to go down this road. The next thing that we're going to look at is around the accounting for associates and joint ventures. When it comes to accounting for any investments that we may have in associate companies or in joint venture organizations, we basically have one of three choices in the way that we can approach it. We can go cost, we can go equity accounting, or we can go with fair value, like we mentioned before. Now, these three options have always been available for the consolidated financial statements that we prepare, or where you don't prepare a set of consolidated financial statements. Maybe all you've got in your books are investments in associates and joint ventures and no subsidiary companies. Well, you could fall back on the option to use fair value as well. That was always there in the old version of IFRS for SMEs. What they've done, though, in this version of the standard is they've clarified the whole issue around undue cost to effort. They said, look, again, when it comes to the determination of fair value of your investments, if fair value cannot be determined without undue cost to effort, then we'll fall back on one of the other two. Either go cost or equity accounting. That would be up to you. But whatever accounting policy choice you make, it must be for all investments that you have in associates. For instance, you might say, well, all my associates, I want to carry them at cost. I might then say, well, all my joint ventures, I want to equity account for them. Now pick a battle and then continue to fight that battle all the way through. So you can't then make the choice on an investment by investment basis. That was not the intention of what is sitting in IFRS for SMEs. So again, some simple clarity in terms of what we can and can't do when it comes to that. On investment property, the definition of investment property does not change. Property, land or a building, or part of a building that is held to earn rentals, or for capital appreciation, or both, rather than for own use, rather than for sale in the ordinary course of business, which would meet the definition of inventory if it's for sale, or if I'm using it for my own use, or for use in the production of goods, or for admin purposes. That would be owner-occupied property. Nothing changes there. What they have changed is they've clarified what would happen where you can't determine the fair value of investment property reliably. While the old version of the standard allowed us to carry investment property at cost, where we can't determine its fair value, if I am going to go with the option of carrying this investment property at cost, less any accumulated depreciation and impairment, in my financial statements previously, I show that investment property as part of my property, plant, and equipment. Now, what the change is now saying is that such investment property that is carried at cost less accumulated depreciation and impairment must be presented separately on the face of my statement of financial position. So basically, I would then have property, plant, and equipment, which is owner occupied, carried at cost less depreciation, if that's the choice that I've made. Again, I'll come back to this in the next couple of slides. I'll show my investment property that is carried at fair value and investment property that is carried at cost less depreciation. So I effectively have three separate lines that I show in my financial statements. So a slight change from where we were before. On property, plant and equipment specifically, a lot of the people that commented on the SME standard, the exposure drafts and the changes that they were expecting on the SME standard, commented on this particular area in particular. And what the issue here was, it was mostly around the revaluation option. As you might remember, under the old standard, we were only permitted to carry property, plant and equipment at cost less depreciation, less any impairment. There was no revaluation option. The revaluation option has now been included, so we effectively have two options in terms of how we can recognize and measure our property, plant and equipment. Whatever policy choice you make, it must be applied to an entire class of property, plant and equipment. So I might say, well, my land and buildings are carried at revaluation, but my motor vehicles are carried at cost less depreciation. I can't then say, well, on my land and buildings, there's one particular building that I'd like to carry at cost less depreciation. All my buildings must be at revaluation, less any depreciation, obviously. All my motor vehicles must be at cost, less any depreciation and any impairment, if it is appropriate. Now, what comes out of this is another change that has now been made to what goes into other comprehensive income. Previously, we had 3 items of other comprehensive income in IFRS for SMEs: foreign currency translation reserve movements, actuarial gains and losses on defined benefit plans, cash flow hedge gains and losses, where we've got effective cash flow hedges. The fourth one, which has now been incorporated, would be revaluation surpluses and deficits arising on property, plant and equipment. Now, I mentioned deficits. Deficits will only be accounted for to the extent that there's been previous revaluation surpluses that have been recognized, and it's a reversal of those surpluses. Where we start off with the deficit, well, then that's an impairment loss, and that must be recognized through profit or loss. So that principle does not change at all. So if you have a look at how we then show these items of other comprehensive income in our books, similar to what we have in IAS 1, we'll be required to show which of these items of other comprehensive income will be reclassified at a future point in time, and which ones will not be reclassified at a future point in time. Now, we've got 4 items of other comprehensive income. Of the 4, 3 are not reclassified. So the ones that you can see in green in front of you, the foreign currency translation reserves, actuarial gains and losses and defined benefit plans, and the revaluation surpluses or deficits on property, plant and equipment, those 3 are not reclassified at a future point in time. Cash flow hedges, those will be reclassified through profit or loss at a point in time. So if you can just bear that in mind as we prepare our financial statements, and make sure that we disclose these separately in the preparation of our financial statements. Now, I'm going to go back to property, plant and equipment. There's another aspect of property, plant and equipment where there's been a change, and this is around the treatment of spare parts and service equipment. Spare parts, standby equipment, servicing equipment, these are all carried as property, plant and equipment if they meet the definition of property, plant and equipment. Now, you may find yourself in a situation where your organization or your client has got an item that they've classified as inventory and has been sitting in the warehouse for the last 2 years. And when it is eventually used, will have a useful life of greater than a year. Now, in that situation, that seems to meet the definition of property, plant and equipment. There will need to be an element of judgment that will need to be applied in such scenarios like this. So what the standard is basically saying, in changing the wording around a little bit, it says, well, go back and have a look at these things. Would this item meet the definition of property, plant and equipment? If it would, then yes, classify it as property, plant and equipment. Your depreciation rate might be lower than an item that is currently in use. If it does not meet the definition of property, plant, and equipment, well then it's inventory, and classify it as inventory and account for it in the same way that you'd account for any item of inventory. Another issue that came out of this particular issue specifically is how we deal with replacement parts. Replacement parts which will add to the benefit that we will obtain out of an asset should be added to the carrying amount of that asset, because it's effectively enhancing the value of that particular asset. So what you then do with those sort of assets is when you capitalize that asset to the cost of your property, plant, and equipment, you take off from the cost of that property, plant, and equipment an estimate of the cost of what was in there already. So what you can then do is that we don't always have a figure for what a part. It might be a motor that forms part of an entire piece of machinery. We don't know what that motor would have cost 5 years ago when we bought it. So you can estimate the cost of the old item on the basis of what the new item has cost you, and obviously then depreciate it. Take off the depreciated cost of that particular item. It doesn't matter that you didn't depreciate it separately in the past. For the purposes of accounting for it under the standard now, this is the guidance that we now have. That will basically deal with what we have in property, plant, and equipment. The next change that has been made is around intangible assets. And here, we're going to deal with intangible assets other than goodwill. We'll come back to goodwill a little later on. Here, we basically have 5 ways in which intangible assets can arise on our balance sheet. Separate acquisition, where we apply cost. We get it from the government. We get the intangible asset from a government through a government grant, in which case we apply fair value. It's an exchange of assets, where we apply fair value again, unless the transaction lacks commercial substance, or the fair value of neither the asset that we're giving up or the one that we're getting can be estimated reliably, in which case we then go with carrying value of whatever we're giving up. Internally generated assets, unfortunately there we have to expense. I know there was a big fight about trying to make sure that we could capitalize these assets. Unfortunately, I think that battle was lost, and we still expense all internally generated intangible assets. Then there's the last one where there's been a change, business combination. While we always had fair value, what we didn't have was we apply fair value if it basically means that we can determine the number without undue cost to effort. So undue cost to effort exemption has now been brought in. And again, similar to what we spoke about before, where you do apply it, you need to explain why you have applied it. They've also gone further and they've said, we assume that all intangible assets will have a finite life. If you can't determine the useful life of your asset, then use a number that is based on your best estimate, but that does not exceed 10 years. So you've got the option here to go and apply your judgment and in terms of determining how long that asset may be of use to you, but just make sure you don't exceed that 10-year period. Those are all the changes that have been made to the intangible asset section of the standard. I did say we'd come back to goodwill. We'll talk about it now. Again, what they've done here, when it comes to goodwill, obviously goodwill arises on when we enter into business combinations. That they've clarified, first of all, that where you enter the business combination section of the standard does not apply to entities that are under common control. Basic common control means ownership of the entity would be similar before and after the business combination. So basically, if the after you've done a group reorganization, shareholders who control the group before are the same shareholders who control the group afterwards, that's a common control transaction. Now, in a situation like that, we'll be required to develop an entity-specific accounting policy for such transactions and to explain as part of the disclosures that this is what we have done. We've gone and we've developed our own accounting policy, and this is the reason why we've done it, and this as the consequence of having done what it is that we've done. This is the accounting that will flow out of it. Now, IFRS 3 in full IFRS has always given us a little bit of guidance in terms of what we should be doing on this. I think as much as it also outlaws common control transactions, well, not IFRS 3, full IFRS. Full IFRS enables us to go to and have a look at other guidance that is given by other accounting in other accounting literature across the world, whether it be US GAAP or UK financial reporting standards, or anybody else who may have given this issue some thought. Go and craft your policy based on what they propose. Where goodwill arises on your business combinations, again, similar to what we had with intangible assets, useful lives. If the useful life of goodwill cannot be established reliably, then the useful life must be based on management's best estimate of how long it may be of use to the organization for. But that number must not exceed 10 years. Whatever number we come up with, we'll be required to go and disclose it in the preparation of our financial statements. That basically covers what we had under intangible assets, business combinations, and the accounting for goodwill. The next section deals with liabilities and equity. From a classification point of view, an organization is required to classify a financial instrument either as a liability or as equity, taking into consideration the substance of the arrangement that it has entered into. Have a look at the contract that you've got in place. What exactly does it entitle you to? What exactly does it oblige you to do as an organization? You might find that there's an instrument on the books that is structured in a way that says the naming of the instrument says it's an equity instrument. But the substance of the transaction indicates otherwise. Well, the accounting cannot follow the legal form of this instrument. It must follow the substance. So here we need to go and have a look at the definitions of financial liabilities, the definitions of equity instruments, to see where we're placed with regard to that particular financial instrument. So unless your organization has an unconditional right to avoid delivering cash or another financial asset in order to settle the obligation that it has contractually, then basically that says to us that that's a financial liability. And that must be accounted for in the books as a financial liability. If, however, there's no requirement to deliver cash or another financial asset, well, then that sounds like it's equity. So therefore, in accounting for these particular instruments, we must therefore have a look to see what the standard will then require of us and what the classification criteria, where the classification criteria then leave us. Where you conclude that the financial instrument that you've got is a financial liability and it must be carried at fair value, for instance, then again, the undue cost to effort exemption can be applied. But in applying it, apply your judgment, disclose that judgment. Sometimes we find ourselves in a situation where we have no cash and we decide to distribute assets to the owners of the organization. So we have a dividend in specie here, for instance. Now, if that is a situation, IFRS for SMEs then says the obligation to shareholders must be recognized based on the fair value of the non-cash assets that are to be distributed. If the fair value of those assets cannot be determined without incurring undue cost or without putting in undue effort into the entire process, then the liability that exists must be shown at the carrying amount of the non-cash assets that will be distributed. That's a bit of a stopgap measure to try and get the liability onto the books. If it works out that the fair value of these assets becomes determinable at a point in time in the future, but before the distribution happens, then the carrying value, the amount of the liability, must be adjusted, as must be the entry that will be processed through equity relating to the distribution of these assets. So the dividend that is taken through equity must also be adjusted. So again, just some clarity in terms of what we do when we've got a non-cash distribution to the owners of the organization. The next bit deals with accounting for share-based payments. IFRS for SMEs, in its scope paragraph, says that an entity applies the section where it's accounting for share-based payment transactions, whether or not the entity can identify specifically some or all of the goods or services that are to be received or that have been received. Now, in a lot of scenarios across, I look across the African continent at the moment, where there's indigenization programs or black empowerment initiatives that are being undertaken, sometimes it's very difficult to work out what value the company is getting in return for issuing shares. So for those of you who haven't come across what I'm talking about, companies issue shares to new shareholders sometimes it's to employees, and sometimes it isn't evident what return they are going to get for issuing those shares, because those particular shareholders do not necessarily introduce any new money into the organization, or where they do introduce new money, they may not necessarily pay the full value of the equity instruments that have been issued to them. Now, in this situation, this is why the standard has been worded the way that it has, to deal with those sort of scenarios where the shares are issued, but the return that the company is getting is not commensurate with the value of the instruments that have been issued. Now, in that situation, where you've got a scenario like that, that would still be in the scope of the standard. That would still be in the scope of this particular standard, but the accounting will be based on the accounting that will need to be applied will be based on the fair value of the instruments that are being given up. If there is a difference between the fair value of the instruments that are being given up and the value of what the company has received in return, the difference is then recognized through profit or loss immediately or over a period of time, depending on what the terms are of the share-based payment transaction that is being undertaken. Now, where this gets a little complicated is where shares are issued to employees in a group of companies. So I happen to be an employee in a subsidiary company, and I participate in a share-based payment scheme. The shares will be issued in the holding company, not at my subsidiary company level. Now, in that situation, where companies have battled a little bit in the past is, well, how do they allocate expenses but across the group of companies, especially in the SME environment where, as an employee of one company, I might also work for other companies within that same group. I might provide service to other companies within the same group. Now, in that situation, the standard now clarifies that where you've got a scenario like this, apply your judgment in terms of the allocation of that group expense. So if I happen to spend 60% of my time in company A and 40% in company B, then the allocation should be on that 60-40 basis. Even though company C, which is the holding company, is going to issue the shares, there's no need now to go and say, well, look, now we need to go and work out, can we see based on timesheets or based on time spent and so forth. We can simply work on some sort of rational basis, and that'll be sufficient for the allocation of the expense. Obviously, it must be justifiable. It can't just be a thumbsuck of, well, this is what we're going to do. We're going to allocate expenses on a 50-50 basis or an equal basis across all the companies. If I happen to spend more time in one place than another, then that must also inform the allocation of those particular expenses. The rest of the standard, apart from clarification of some terms that are used, the rest of the standard remains the same. Where you've got equity settled share-based payment schemes, these fair values are determined at the grant date only, and there's no changes that are made after the grant date. If it's a cash settled share-based payment scheme, well, at each reporting date, a reassessment of fair value must be undertaken, and any changes in the fair value must then be recognized in profit or loss until such time that the share-based payment scheme, the options are exercised and the shares are actually issued. Where you've got cash alternative schemes, well, determine what part of it is equity settled, what part of it is cash settled, and then the accounting will then follow. The equity settled if it's equity settled, and the cash settled if it's cash settled. And that's basically where we are with that. An area where we've had major changes in the last, since the old version of the standard, is on income taxes. And here, what has happened is that the ISB have effectively rewritten the standard. And in rewriting this particular section of the standard, they've basically taken what we have in IAS 12 in full IFRS. You'll recall when IFRS for SMEs was issued back in 2009, at that point in time, the ISB had every intention of reissuing IAS 12. And in reissuing IAS 12, that would have resulted in a standard that looked more or less like what we had under the old version of IFRS for SMEs. However, as we all aware, I think there was some difficulty in applying this section of IFRS for SMEs, hence this revision. And in this revision, it basically brings up the principle of, in working out what your taxes are, your deferred tax specifically, simply compare the carrying amount of your asset, the book value of your asset, against the income tax value of that asset or liability. Any difference between the two will give rise to a temporary difference. We take that temporary difference, apply the applicable tax rate to it, and what comes out in the wash will be a deferred tax asset or a deferred tax liability. And we recognize that in our books. I'll talk about these things in a little more detail now. The carrying amount of the asset is pretty much what we show it in our accounting balance sheet at. The tax base is what the taxman would recognize for that particular asset or that particular liability. We'd obviously need to take into consideration any tax losses and any tax credits that would not sit on the accounting balance sheet, but would sit on the taxman's balance sheet if we were to prepare a taxman's balance sheet. Now those are the numbers that we then, so the difference between those two numbers would then give rise to the temporary difference that we're referring to. We then work out what the applicable tax rate is. And generally the applicable tax rate will be the currently enacted tax rate. However, you may find yourself in a situation where the tax rates are set for change. In the next year, there'll be a change in the tax rate, and that number has now been pronounced. Now, to the extent that it's been pronounced, even though it might have not have gone through the whole process of the law being changed and all of that, but given where we've been with and what we know about the jurisdiction in which we're operating, if the government proposes a tax rate change, if that proposal generally carries the day, then that's effectively a substantially enacted tax rate, and we can apply that. But again, it will take some judgment in deciding whether or not it's substantially enacted at that point in time. If it's not substantially enacted, then fall back on the current tax rates, and you then apply the applicable tax rate at that point in time. Now, the applicable tax rate will depend on what assets or what liabilities we're dealing with. Similar to what we have under full IFRS, and that's been brought into IFRS for SMEs now. If I find myself in a situation where I've got property, plant, and equipment, then I'm going to provide for deferred tax based on my use rates. However, if I'm dealing with investment property, or I'm dealing with revalued assets, and my intention is to dispose of these assets at some point in the future, then I use the disposal rate in computing my deferred tax. So the presumption with any revalued assets or any investment property, despite what my intention might be with that asset at some point in the future, is that I'm going to go with the disposal rate. What would happen if I dispose of a particular asset? Now, using the disposal rate does not necessarily always mean that it's the rate it's a capital gains tax rate if capital gains are applicable to me. It might mean that there might be a recoupment of allowances that have been permitted of me in the past. It might mean that there may be portions of my asset that I'm permitted to claim as allowances that would not be taxable at all, where I would not need to pay any capital gains tax. It might mean that there's a portion where I would pay capital gains tax. Now, depending on what each of these taxes might have different rates. So I'll need to sit back and work out what would be the tax consequence of disposal of this asset at my reporting date based on its current carrying value and based on that asset's tax base. Those based on coming out of that computation, I would then work out what my deferred tax asset or my deferred tax liability is. Now, whatever number I work out, I take that number as it is. There is no discounting that will be applied to it. Even though the reversal might only happen in 5 or 10 years' time, his time value of money might be an issue everywhere else within the standard, but not when it comes to the computation of my deferred tax. Another issue that I may want to that I need to consider as well is where I've got deferred tax assets. Under the old version of the standard, where I had a deferred tax asset, I also had to go back and have a look to see, is it likely that I'll be able to utilize this asset? And if it's not, then I recognized the full extent of the asset, and I then wrote it down to what I thought I would be able to utilize. Now, under the changes that have been proposed here, we only recognize our deferred tax assets to the extent that we'll be able to utilize them. Now, folks, when it comes to this, if we don't think that we'll be able to utilize the full amount of the deferred tax asset, then we need to explain that judgment. We need to disclose what judgment we've applied and why. Again, the same principle that we've always had in the past, where you decide that you're not going to show a deferred tax asset in your books, then the question will arise around your going concern. Are you a going concern? Are you not? To the extent that you think that you are a going concern, well, then that deferred tax asset, unless there's a compelling reason for it, that deferred tax asset must be shown in your books. There's a few other things that have been where there have been changes to the standard. One of them being specialized activities and exploration for and evaluation of mineral resources. With this particular area, what the ISB have done here is just basically clarify the accounting around any exploration and evaluation costs that are incurred. Again, the clarification being where you incur exploration and evaluation assets, exploration and evaluation costs, and they will result in an asset, then those assets are measured at cost at initial recognition. Subsequently, those assets are then accounted for in terms of, are they property, plant, and equipment, or are they intangible assets? And whatever policy you apply in those particular areas, you need to apply consistently with these exploration and evaluation assets. We also need to take into consideration any obligations that we might have to restore a site that we have been mining, or dismantle any equipment that we might have put in place, any civils that we might have dug into a piece of ground. Any of those costs that might be incurred, those need to be taken into consideration and the necessary provisions created, obviously with the debit going against the asset. Where we do create these exploration and evaluation assets, we also need to assess them for impairment. And the assessment is undertaken if there are indicators of impairment. The indicators of impairment being, maybe we've got a mining claim that we pegged, and we'd started spending money on exploration on that particular site, and then we stopped. Maybe because it's a gold claim that we have, and we stopped because, well, the gold bearing ore was too deep, and at this point in time, with the gold price sitting where it is, it's not feasible for us to actually start mining that particular piece of ground. Well, if that's the case, that in itself is an indicator that we may have an impairment issue. So therefore, test that asset for impairment and recognize any impairment losses as necessary. That then takes us to the last section of IFRS for SMEs, which is section 35, the transition to IFRS for SMEs. Now, for those entities that have not yet transitioned onto IFRS for SMEs, they would be quite concerned about what is sitting in this particular section of the standard. For those of us who have been applying IFRS for SMEs, this will not necessarily be an issue at this point in time. Suffice to say, though, that previously, under IFRS for SMEs, you could not be a first-time adopter of IFRS for SMEs more than once. This has now been changed. I'll come back to this in a moment. Let's deal initially with the people that are applying some other version of an accounting standard, whether it be IFRS or it might be whatever generally accepted accounting practice we might be applying in our jurisdiction, and we're looking to move on to IFRS for SMEs. The standard tries to make it a little easy for us to transition onto IFRS for SMEs, in that it simply says, well, recognize all assets and all liabilities that the standard recognizes in terms of the rules that the standard sets out. There may be certain things that would not meet the criteria for recognition on our books that we might have had under our previous accounting framework. Now, those things we'll need to take off our books. So de-recognize those assets and those liabilities that the standard does not recognize. You may find yourself in a situation where there may be certain things that need to be reclassified. Again, those will need to be reclassified into the appropriate place. Say, for instance, I might have a situation where I showed intangible assets, and in there I included my goodwill. Well, goodwill must be shown separately on the face of my balance sheet, so therefore I'll need to reclassify it into the appropriate place. Once I've done that, and I've worked out what assets, what liabilities should be sitting on my balance sheet, and I've put them into the right place, I then apply the measurement principles that are sitting in IFRS for SMEs to recognize all those assets and all those liabilities. Now, IFRS for SMEs gives me what are called mandatory exceptions and optional exemptions. Now, mandatory exceptions apply to things like my financial instruments, where I'm required to make sure that there's certain things that I'll need to bring onto the books, or certain things that I'll need to take off the books. It also talks to things like I may find myself in a situation where I have a loan from the government that I have not been accounting for as a government grant. Maybe it's a below market interest rate loan. Now, in that situation, I need to bring it onto my books, and it gives me an option in terms of how I can bring it on. And it says, well, bring it on at its current carrying value in your books, whatever that number is, and to the extent that it may be below market rates, and Section 11 and Section 12 might have said, well, there's a gain here. Well, don't recognize that gain on day one. We don't want to see it in day one, but subsequently account for that instrument in terms of Section 11 and Section 12. So therefore, you need to take the gains and losses that they will then arise through your income statement. Then there's other areas where we've got optional exemptions. And here it might be things like property, plant and equipment, where I might decide to go with my previous carrying value of my assets in my books and use that as deemed cost. Or maybe there was a revaluation that was undertaken in the recent past. I can use that as deemed cost. Or I can use a revaluation that was undertaken maybe 2 years ago and use that as deemed cost. So there's various options that are available. We're not going to go through the detail of the mandatory exceptions and optional exemptions at this point in time because there are quite a few. But suffice to say that they are there, and the whole point behind them is to try and enable the transition from GAAP to IFRS for SMEs to be as smooth as possible. What I am going to talk about, though, are some of the new requirements that have now been put into the transition process that we need to be aware of. I did mention that if you adopted IFRS for SMEs previously and you decided to move off it, you couldn't be a first-time adopter again. So you couldn't be a first-time adopter of IFRS for SMEs more than once. However, with the change that has now been made to the standard, you can readopt IFRS for SMEs more than once. And effectively, you've got one of two choices in terms of how you readopt. You can either go and apply Section 35 and basically start from scratch as if you had never applied the standard ever in the past, or you can go through the process of readopting the same way that you deal with a change in accounting policy, where you go back and say, well, if I continued applying IFRS for SMEs, this is what the numbers would have looked like 2 years ago, and therefore, if I take that as my starting point and I apply the same principles going forward to last year and the current year, where would I be? You can do that. So the option does exist in the standard now. That will hopefully make it a little easier to the extent that people are not quite sure which way they want to go. The government loans I spoke about. Any government loans at below market rates are basically accounted for in terms of basic and other financial instruments and the government grants section of the standard. Now, if you do have these sort of instruments in your books, any changes and you adopt IFRS for SMEs for the first time, then the accounting must be done on a prospective basis. You can't go back and say, well, look, the benefit that I'm getting from the government, from the loan below market rates, I want to recognize that as a government grant at the transition date. That will not be possible. So any accounting will need to be done on a prospective basis. Sometimes we find ourselves in a situation where we've got operations that are subject to rate regulation. I may have a situation where I run a service station, a fuel retail outlet, and I'm told what price to charge for my fuel. Now, in that situation, standard says, well, if you have operations that are subject to rate regulation, you may elect to measure your assets that are related to those particular operations at the whatever your previous carrying amount was under your old accounting standards. That's the number that you then show in your books. So again, it makes it a little easier for people when it comes to trying to determine the fair value of these assets if it's fair value that you're going to if it's deemed value that you want to try and determine. Again, in determining fair value of assets and liabilities, you may choose to go with deemed cost, and that deemed cost may be based on an event that occurred at the point of transition, or it may be based on what happened 2-3 years ago. It's up to you. But whatever number you decide to use, you simply need to disclose that this is the basis for the determination of fair value for a particular asset or a particular liability that I've got in my books. Now, all of this is effective for periods beginning on or after 1 January 2017. You are allowed to early adopt it, provided you early adopt all the amendments. You can't pick and choose which ones you want to adopt, unfortunately. You have to adopt everything at once. And in adopting in applying the standard, application will be retrospective unless there's specific areas in the standard that allow you to apply it on a prospective basis. The tax requirements, for instance, will be applied on a prospective basis, and the amendments relating to the revaluations will also be applied on a prospective basis. So if you can just take that into consideration as we move on to IFRS for SMEs. I think when I look at what is sitting in this particular standard, for me, it's clarity in terms of where we are with the current standard. It gives options that we've been clamoring for a while now. So it's a no-brainer from where I'm sitting that companies should be looking to early adopt this particular standard. But I guess it's up to each one of us to decide which way we're going to go.